Hi and welcome to the Market Alert for Tuesday, the 2nd of March 2020. As I've said for the last week or so, the bond market yields are causing a bit of a problem for the markets. The Fed came to the yields rescue the other day, as it were, and managed to keep it in check. But whether they can keep control is another thing. So yesterday, the stocks, cryptos and bond yield surge amid commodity purge. Now, we've also spoken about this as well, that JP Morgan have announced, and Goldman Sachs, that from this month you're going to see the start of a major commodity bull market as well, which will be an interesting one, which means people or traders will move from the stock market to commodities in order to achieve this. As the yields become higher, the higher they move up, then people will rather go into bonds or into another sector, because the stock market will struggle. As it said, financial conditions in the US are now at their tightest in 3 months. And more on this, Deutsche Bank, central banks simply can't afford higher rates with global debt so high, something that I've been talking about for a long time, and in particular last year, where they printed something like 7 trillion, and the 1.9 trillion is just going through as well. There is little doubt in my mind that central banks will eventually lean quite hard against a sustained rise in yields. They've already started to do this with the yield control system, it's called, or the yield control curve, YCC. They simply can't afford to see it happen with debt so high. And this is what I've said for years, that they can't increase interest rates because the repayments on the debt and also the issuance of new debt is a major problem. They've painted themselves into a corner. These are so-called academics are absolute pillocks, because anybody with half a brain cell and common sense can see that it's like just keep adding the credit cards and get another credit card, don't pay it off, get another credit card. It's just insanity. All because they didn't let the banks go bust in 2008. We now find ourselves in this situation where there's nearly $10 trillion on the Fed's balance sheet. Incredible. And there's something else that I mentioned the other day about 1.52%. Well, Bank of America split the difference on this and said that 1.75 is the tipping point for the bonds. Both the Fed and the European Central Bank have reiterated their reassurance. They're always doing this. I will reassure you, we've got your back. That monetary policy will remain supportive, and that's the other one. This other word, supportive. Accommodative as well as the other one. But markets may be challenging central bank credibility. They have zero credibility. Who in their right mind is going to have any credibility with regards to any central bank or member of the Fed or IMF, etc.? And also here, bond market calls Fed's bluff with biggest short ever. This is a bit worrying. A reversal squeeze in UTS, US Treasuries, could come fast. So we're going to have to keep an eye on this, because it's going to batter the gold price, pressure on the silver market, and also on the stock market as well. But yesterday, miraculously, the implied volatility is down to 17.85 from 21.36 on Friday. So this is Fed intervention. There's no doubts about that, bringing some sort of support to the market, sending the implied volatility back to amber, having had the 1 day of red there. So the yield currently is overnight is 1.42, and yesterday you can see that that's 8 p.m. This is going to be US time. So let me just have a look at the 5-day. That's just will be a bit easier. Let me see if I can remove that label out of where we are. So Monday, you can see it was a fairly quiet range there. We've got a high yesterday of, let's have a look, try and pick on there, 1.45. 7, but the 1.75, I'll go with that, and also the 150. We started to create a problem, didn't it, on Friday, and that's why they give some serious thought to this and did whatever they could with the yield curve control mechanism that they have. They have all these controls in place: plunge protection team, yield curve control. The last thing they need is interest rates going up. That is the last thing. That's when it all falls apart, if interest rates go up. And news, while we're here, let's have a quick look. There's no news today. It's no news Tuesday. The market's got to make its own direction because there's no economic news to assist. And what have we got on Wednesday? So it must be non-farm payroll this week if we've got the ADP out tomorrow. And we do. We have Powell out on Thursday, and we've got the weekly claimless figures as well. And we've also got the non-farm payrolls. They're out on Friday as well. So let's have a look, see where the markets are on the overnight. So it's been an interesting night. I woke up just after 1 a.m, made the mistake of looking at the markets, and particularly the silver market, which I'll talk about in just a moment. But the Dow, you can see yesterday moving to the upside, stopping at the 62% retracement that we drew in yesterday from this high to Friday's low. And prices have stopped there at the moment. There's been a bit of weakness overnight as well. I need to hold above this 38 that they went through during yesterday's session as far as the Dow is concerned. Meanwhile, in the German DAX, is this the DAX? This is the DAX. We want the daily chart, and also we can see yesterday that the market went through the 78. Very interesting picture here when we look at yesterday's trades in more detail. And you can see that, again, we've got a bit of a reversal going on there, back below the 20 bar moving average at the moment, and also heading towards the 5 bar. Let's just draw in some fibs for the downside on this. And I'm just going to remove that 78 and 89 at the moment. If the market moves to the upside and turns around, then I will draw in from here down to here. But at the moment we've got a bit of weakness there. So let's focus on the downside fibs at the moment. These are the three that you want to be taking note of, particularly the 38, because that takes you below the 5 bar moving average as well. The 50 takes you just towards the low, and the 62 will be below yesterday's low as well. So they're the three areas of support that need to be maintained. And on the upside, we'll go from this high to this low. So let's just do this, and you will see, and I'll just right click, select these, drag these out so you can see these. I tell you what, let me just remove these, because you can always put these back on depending on the direction the market goes. So on the upside, we've already gone through the 38, we're already through the 50, and we're sitting on the 62. So having gone through this 62 yesterday, we're currently finding some support here, but we've also got resistance at 78 where the market stopped during yesterday's session as well. And 89 will also give this market a bit of grief on the upside, but there is no economic news today, so the market is free to move higher. And then finally, as I said, I woke up early this morning and made the fatal mistake of having a look at where silver was trading, and then spent a couple of hours watching it trade as they monkey hammered it to the downside. And I have absolutely no reason why they did this, apart from they must have some still futures contracts that they want to buy back cheaper. But as you can see there, it was relentless through to 2 a.m. Then the market traded sideways. I managed to go back to sleep for an hour or so, and then dreaming about the price of silver as well. So trying to think where it would actually be when I woke up. And as soon as I woke up, they did this, and you can see how they've bought back into the market here and brought prices back to above $26. I just don't know why. There's absolutely no reason whatsoever. I thought the yield curve had exploded to the upside and gone past 150 or something overnight. Gold had been hammered, and silver was moving in sympathy with the actual gold crush, but not the case at all. So I think what's happened here is that the Asian market have taken advantage to slam the price and bring it back. There's absolutely no reason, because the March contract expired last week. The delivery by JP Morgan and Goldman Sachs was being taken and accepted. So very odd indeed. I don't see how they can buy anything back any cheaper unless they're starting to switch sides to the long side. Who knows? So there you go. That's a roundup of yesterday and also today's areas of where the markets could trade to. And now I'll just finish off the alert with a very quick whistle stop talk, because I've already gone on for 10 minutes in this first part. So let's just have a quick look, see what happened yesterday. And immediately, if I just scroll back through the recording. When I finished recording yesterday morning, we were heading back towards the 200 MA. The market drove through this yesterday when the futures market opened. It already set a precedent, really, that it was going to move to the upside, and also because of the reasons I'd spoken of with the yield curve control on Friday, etc. We knew it was going to be a bullish move to the upside, and that's precisely what happened. The market holding above the R1, and then as soon as the market opened, we were straight up into the 78%. I just drag this back. The 78% that I drew in yesterday's morning market alert before the market opened, the market traded straight to this level, and also the 20-bar moving average there. However, prices had already moved from this low to here is 100 points, and we managed to move slightly higher, which we'll see in a moment, up to the 14,000 level. The market found resistance there and then started to trade back, which you can see here. Now the market's moved 150 points from 6:30 a.m. and this is an important thing to remember, that once the DAX, 150 points in the DAX in a couple of hours is a big move. So prices then will trade sideways, and this is where you can end up stuck in these sideways moves where there's losing trades like this one, particularly the market. You take into account that the Fed's done everything it wanted to do to control the yield curve. The plunge protection team have come in. The market's moved to the upside. So to go short or try and short with those fundamentals is incredibly difficult. And you'll see here how they immediately buy back these markets at these levels. In particular, it's a fib retracement from 62% from recent swing high to low as well. So the market finds support here, comes back, and then we've got potential long there as well, which wasn't filled. Then there's a second one, but then the market's lost all of its mojo. There's no interest in the upside either, so prices just trade sideways. We then get another potential short, which the market fills, which you can see there. This does move a bit lower, but you'll see it trades down to that 89. You can see the 78 and 89 level here, drawn from here to here. And you know that they're going to try and find some sort of support, and you'll see immediately how they buy back in at these levels. So prices then trade sideways and into the news for the morning, sideways to lower. And this is because, as I say, the market's put on 150 points. It's more likely just to trade in a range, and that's exactly what we're seeing there. Now the afternoon, the cash market in the Dow, as we move along here, let's just see why that hasn't moved along. Okay, I'll just drag along. So you can see prices range bound throughout the morning, and then we get into the afternoon session here, and prices move immediately back above the 200 MA. And what's interesting here is this pattern that you will see, which I've highlighted on many occasions. So you'll see prices now starting to come back, and we've got these fibs drawn in, which I'll redraw in a minute because these are drawn from the wrong place, by the way, so ignore these. I've drawn from here to here because I was expecting the market to come back here, but then I had somebody turn up at the door, so I then came back and redrew them, and you will see if I just put them back on there. This 62% here is the interesting bit. So you've got, it's part of the Elliott wave thinking of how markets move. So you've got this up back, it's long, and then we move to the upside, and that's exactly what happened there. We see them spike in volume, prices coming off the low. The low of the next bar doesn't go anywhere near the previous bar's low, and then we move to the upside. Unfortunately, we had the I think it was the PMI news there, and then eventually the market breaks through, trades back up to that 78%, which is what the blue line is there. And then prices trade sideways and continue to move back up to the R2, which I'd spoken about in yesterday's market alert. Now, it stopped recording for some unknown reason, so let me go back to the German DAX, and we'll just wind back on the 2 minute so that you can see the final outcome there. So this is where we were. We've got the blue line up to the R2, and there you can see this 78% retracement became a support level, and inside of this you've got another 62% retracement and prices moving higher. And I'll just show you that. Just take out this one, and then from this low to this high, you'll see how they bought back at the 62% retracement there. And you can see this. I'll just remove all of these others. There's the 62, and if we just do this, you can see there the market coming back to the 62.76. As soon as we close back above the 5-bar moving average, prices then remain above the 5-bar until we close back here at the R2. Okay, that will do it for this one. If there is anything else to report, I will let you know. No news today, so the market's going to make its own direction, so keep this in mind as well. As ever, thanks for watching. See you in the next one.